Question number 5A says, Elcom Limited is planning to introduce a new product. Market research information suggests that the product should sell 100,000 units over its life cycle at a price of shillings 420 per unit. The company seeks to make a markup of 40% of product cost. Life cycle cost of the product will be as follows. So we have all those costs. Now we are required to get the life cycle cost per unit. Life cycle cost per unit. So that question has come from what we call pricing decisions. Pricing decisions, and specifically life cycle costing. Life cycle costing method. Life cycle costing method. That's where the question has been extracted from. We are told to get life cycle cost per unit. So life cycle cost per unit life cycle cost per unit. Now this one we require that we get. We require that we get total life cycle costs. We divide by total number of units. Number of units. Total number of units. Total number of units. So this is what we will do. We have the fixed costs that we can clearly see. So we are going to add them. You can see design is 10 million, marketing is 5 million, and end of life cost is 4 million. So if you sum those ones, 10 plus 5 plus 4, that gives us how many millions? 19 million. So tutaweka hiyo hapa 19 million. That is the fixed cost. Plus there is some variable costs. Now the variable cost, you can see it is 200 per unit. So this will require 200 multiplied by the number of units, which we are told they are 100,000. So you divide this by 100,000. Divide by 100,000 so that we are able to know what is the unit cost. What is the unit cost? Shillings 390. Remember I told you when it comes to life cycle costing, there are two approaches. There is the total. Kama hii now tunatumia here, this is the total. Combine it. The second one that we had the last time we said is the pro rata, where you divide the cost and revenues per period. Okay. Number two, we are told to get the cost gap. We are told to get the cost gap. Cost gap. Now, cost gap, we will require to come here and say we know so well that cost gap is given as actual cost, U minus target costs. U minus target costs. It is given as actual costs, U minus actual costs. How do we get target costs? Now, target costs is given as market price, minus desired profit, Target costs is equal to market price minus desired profit. So with that, we are already in the know that the market price of this product is 420. Then we are also further told that the markup is 40%. Now this markup is the relationship between profit and cost. And what we have here is the price. So you must convert it to margin. And the conversion goes like this. 40% is currently 40 out of 100. So if you want to convert to the margin, what you do, you add the numerator to the denominator there. You add the numerator to the denominator. That converts markup to margin. Then you multiply by the price of 420. So I want you to give me the profit first. Give me the profit first. 120. 120. So this one now means that our target cost is shillings 300. And therefore, we can comfortably come and say that our cost gap is, this cost we had gotten earlier here, this one is our actual cost. So it is that 390 minus 300. That means that our cost gap is 90 shillings. Our cost gap is 90 shillings. Our cost gap is 90 shillings. The next requirement is the management accountant estimates that if the company spends additional 1 million on design, the manufacturing cost per unit could be reduced. Compute the maximum manufacturing cost per unit that will be tolerated if the company was to earn the required markup. The company was to earn the required markup. So we will come here and get to compute new manufacturing costs. New manufacturing costs per unit. New manufacturing cost per unit. So the question says that we must maintain the markup as it is. We must earn the profit. So if we have to earn the required profit, we will have to come here and say current profit. Current profit is equal to, we are already in the know that 1 unit is giving us a profit of 120. It's giving us a profit of 120. And we are also aware that we are producing 100,000 units. So that means currently we are making a profit of 12 million. We are making a profit of 12 million. Making a profit of 12 million. So we will then proceed and say, we know that if we want profit, we must have revenue minus costs. If we want profit, we must have revenue minus costs. So we are already in the know that our profit is 12 million. 12 million. And then we also know that our selling price is 420. So if we multiply this by our units of 100,000, that will give us the revenue. That will give us the revenue. Then we less the costs. The costs which we do not know. There is a missing element. So based on that, compute and give me the amount of cost. Compute and tell me how much should the cost be. We have 30 million. Eh? We have 30 million. 30 million. So now we will say let C to be equal to unit manufacturing costs. Unit manufacturing costs. If you let C to be unit manufacturing costs, then if you go back here, you see now here, where we have the total cost. So this 19 million still remains. And then we are told we will have to introduce an extra how much on design? 1 million. We will have to spend an extra 1 million. So that 1 million is brought there. So those will be the fixed costs. Then for the variable, this 200 is what now is missing. So we will say C times 100,000. Now these ones are the ones that should give us 30 million. So I want you to compute and tell me C should be how much per unit. Compute and then tell me C should be how much per unit. C should be how much? This shillings 100. Shillings 100. So that now should be the variable manufacturing cost per unit. The variable manufacturing cost per unit. And then we are okay with that. We proceed. And we are told to manage cost effectively, the company should emphasize on cost management at the planning and design stage. Explain decisions that can be made at the planning and design stage which can affect the cost of product and reduce the cost gap. and reduce the cost gap. So the measures that we can take, the measures that we could take, the measures. Now, you need to know what exactly is the cost gap or where is the cost gap. What you can see here is we are incurring 390, but we are supposed to be incurring what? 300. So we are spending more. We are being too good to our customers, which has the effect of denying us the profit. So what can we do? Number one, you could say use less complicated designs. Less complicated designs. We use less complicated designs. Something else is reduce marketing and distribution costs. You reduce marketing and distribution costs. Distribution costs. So you need to check, how do you market your product? Do you use print media or the audio, like the TVs and so on, which could be expensive? You need to check on that. When it comes to distribution, you could even now start asking your customers to be coming for the products. Instead of you taking to where they are, they can start coming for the products. Another measure that you could recommend is use cheaper materials. Use cheaper raw materials. Use cheaper raw materials. Use cheaper raw materials. Now that can be achieved in two ways. One, you can negotiate with the current supplier so that they can reduce the price. If they are not able to reduce, you can now change the material or change the supplier. Change the material or change the supplier. And finally, you can also seek to use cheap labor. Use cheap labor or cheap labor. Let's put it that way. Use cheap labor. So that one is also very, very possible in many ways. One, you can call your current staff and tell them from today onwards, the salaries have been reduced. And those of us who have been working during this corona period, we are familiar with that story. When corona came in, we were called, and number one, we were told the salaries have been reduced. Some of us even by 60%. Others, we were called and we were told, now we can no longer sustain you, so you go home, you can fire. But in the case of a going concern, you don't fire. What you do, brother, if you fire, because there's also an option, if you fire, you replace with cheaper labor. So if the current workforce or if the current worker at 70,000 per month, you fire those ones and then you employ the ones that you will pay maybe 40 or 30,000. Obviously, there are implications in terms of experience and so on, but those are some of the areas you can use to navigate. So that is all about that question, and we can bring our discussion to the end.